the Saudi Arabia extending cuts into August, along with Russia and the Algiers cuts. What does that say about demand, and what does that say about sentiment?
Well, in a normal universe, under normal circumstances, if Saudi Arabia cuts production by 1 million barrels per day, that's a very significant event. The market reaction, however, right now was almost non-existent. And the main reason for that is that the market perceives Saudi Arabia's cutting production as a sign of weakness and not as a sign of strength. It sees it as an actual acute difficulty with demand in the markets. The Chinese demand story didn't really transform into the butterfly that everyone was expecting it to. And pretty much the Atlantic basin is mired in recessionary fears. So it doesn't really feel as if the market is growing, and hence there's no reaction.
All right, so you're saying the market doesn't feel like it's growing, but in all fairness, in June, we saw China have its second highest monthly crude imports on record. First half of the year trending higher than last year. Is that sustainable? Are we seeing, it may be slower than expected, but are we seeing that China reopening that can give a real boost to the price action in the oil market?
Well, one of the consequences of all the things that have happened in the first half of 2023 is that a lot of people have lost trust. And a lot of people see the high imports of Chinese refiners in May, June, and they think that the Chinese are just building stocks to run them down subsequently in the second half of 2023. So even though we have tremendous import figures over the past 2 months, because the Chinese economy feels so weak, because the PMI indexes are just really horrid for this time of the year, everyone expects that this is not a sign of strength. This is a sign of hoarding before the real impact of the recession hits. And that's not good.
All right, certainly something to think about there. I also want to talk to you about the Fed minutes. They're going to be released later today, the Fed minutes from the meeting back in June. It's going to give us more insight into this so-called hawkish pause. How does that impact the oil market? And also the thought, you look at the CME FedWatch tool, a tool that we use here, there's more than an 80% chance of another hike coming up in 21 days. How does that impact the oil market?
Tremendously. Trust me, it would impact the oil market much more than the Saudi Arabian production cut announcement, or let alone Russia's 500,000 barrel per day export cut. People will be looking at the Fed. People will want to gauge the sentiment really in the market, whether we are in for a soft landing or it's going to be really, really hard. And depending on that, we'll see a lot of movement today. So after yesterday's relatively muted trading session when the U.S. was enjoying the holiday, today will be very eventful. All
right. So one thing I want to ask you about, coming full circle to those Saudi Arabia cuts extending into August, their break even's about 80 bucks, 81 bucks. Right now we're seeing Brent at about 75.5. Do we expect that production cut to get extended past August? What other movements can we see from the OPEC Plus members? Because it just seems like oil just can't find its way this year.
Yeah, that's a very, very good question, because sustainably Saudi Arabia was producing 9 million barrels per day that it produces right now, only twice in history. Peak COVID and the great financial crisis. It's not really tenable for the Saudi Arabians to do this, basically to sacrifice themselves, and everyone else to piggyback on their sacrifice. I think there will be a tremendous amount of pressure from Saudi Arabia towards other members to join the club of those who cut, but Saudi Arabia cannot realistically cut any further because they need the budget revenue. If they cut any more and the prices don't move still, it's going to be a tragedy for the national budget. So expect a lot of pressure on other OPEC Plus producers and potentially more cuts coming from them too.